Hello, and welcome to our comprehensive guide on the pivotal U.S. tax law changes anticipated for 2026, and I will be your narrator through this journey of understanding the evolving tax landscape. In the chapters to come, we will dissect the upcoming modifications, identify who will be most affected, and explore proactive measures you might consider. It is essential to state that the content of this series is for informational and educational purposes only. It should not be construed as financial, legal, or tax advice. We strongly encourage you to consult with a qualified professional for guidance tailored to your individual circumstances. Let's begin by addressing the fundamental question. Why is 2026 a landmark year for the United States tax system? The primary reason is the scheduled expiration of key provisions within the Tax Cuts and Jobs Act of 2017, widely known as the TCJA. This legislation represented one of the most significant reforms of the U.S. tax code in several decades, introducing broad changes for both individual taxpayers and corporations. However, a critical aspect of the TCJA is that many of its provisions impacting individuals were not enacted permanently. Instead, they were designed with a sunset clause, causing them to expire at the end of 2025. This means that unless Congress intervenes to extend these provisions, the tax laws for individuals will largely revert to their pre-2017 framework on the 1st of January, 2026. This is not a minor adjustment. It is a substantial shift that will have implications for nearly every American who files a tax return. So, what are the primary areas that are set to undergo this transformation? First and foremost are the individual income tax rates and brackets. The TCJA lowered income tax rates for most brackets. For example, the highest marginal tax rate was reduced from 39.6% down to 37%. Come 2026, these rates are slated to return to their higher, pre-TCJA levels. In practical terms, this means that for the same level of income, you could find yourself in a higher tax bracket and consequently owe a larger amount in taxes. We will delve into the specific details of the old and new tax brackets in a subsequent chapter. For now, the key takeaway is the potential for a tax rate increase for a significant number of taxpayers. Next, let's turn our attention to the standard deduction. The TCJA nearly doubled the standard deduction for all filing statuses: single, married filing jointly, and head of household. This was a major simplification for millions of taxpayers, as it reduced the need to itemize deductions. For context, the standard deduction for a single individual in 2025 is projected to be in the vicinity of $14,600. With the expiration of the TCJA provisions, this amount will essentially be halved, after adjusting for inflation. A lower standard deduction will likely mean that more taxpayers will need to revert to the more intricate process of itemizing deductions, such as mortgage interest, state and local taxes, and charitable contributions, in an effort to lower their taxable income. This leads us to another significant alteration: the limitation on the state and local tax deduction, commonly referred to as the SALT deduction. The TCJA imposed a cap of $10,000 per household on the amount of state and local taxes that could be deducted. This had a notable impact on residents of states with higher tax rates. This $10,000 cap is set to expire at the end of 2025. While the removal of this cap might appear beneficial for those in high-tax states, it is important to view this change in the broader context of other returning provisions that could potentially offset this advantage. Another area of considerable change is the child tax credit. The TCJA temporarily increased the child tax credit from $1,000 to $2,000 for each qualifying child. It also made a larger portion of the credit refundable. In 2026, without legislative action, this credit is scheduled to revert to its pre-TCJA amount of $1,000 per child. The income thresholds for eligibility are also set to change, which could result in some families who currently benefit from the credit no longer qualifying. Furthermore, the TCJA introduced the Qualified Business Income Deduction, also known as the Section 199A deduction. This provision allows owners of pass-through businesses, such as sole proprietorships, partnerships, and S-corporations, to deduct up to 20% of their qualified business income. This has been a substantial tax benefit for many small business owners. This deduction is also on the list of provisions set to expire at the end of 2025. It is also important to briefly touch upon the estate tax. The TCJA doubled the estate tax exemption, which is the value of assets a person can bequeath to their heirs without incurring federal estate tax. This exemption is indexed for inflation. In 2026, this significantly higher exemption is scheduled to be cut by about half. This change will likely subject a greater number of estates to the federal estate tax. As you can discern, the sunsetting of the TCJA provisions will have a wide-ranging impact on individual taxpayers. It represents a complex network of interconnected changes that will necessitate careful planning and consideration. In our forthcoming chapters, we will explore each of these topics in greater detail. We will examine the specific figures, discuss the potential consequences for various taxpayer profiles, and outline general strategies that individuals might consider in light of these impending changes. It is crucial to emphasize that this series is not a political commentary. Our objective is to provide a clear and impartial overview of the tax law changes that are currently scheduled to occur. The political climate can, and likely will, influence whether some or all of these provisions are extended or amended. However, as the law currently stands, the changes we have discussed are poised to become our new reality in 2026. Thank you for joining me for this introductory chapter. I trust this has provided you with a solid foundation for understanding the significant tax law changes on the horizon. In our next chapter, we will take a more granular look at the individual income tax brackets and how the return to pre-TCJA rates could impact your personal finances. I look forward to you joining me then. Hello and welcome back. In our previous chapter, we laid the groundwork by introducing the major tax law changes scheduled for 2026, stemming from the expiration of the Tax Cuts and Jobs Act, or TCJA. Today, we will delve deeper into one of the most direct and impactful of these changes: the shift in individual income tax rates and brackets. As always, please remember that this content is for educational purposes only. It is not financial, legal, or tax advice. We highly recommend consulting with a qualified professional for personalized guidance regarding your specific financial situation. Let's begin our detailed examination. The TCJA established the 7 tax rates that we are familiar with today: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. For many Americans, this structure resulted in a lower marginal tax rate and, often, a reduced overall tax bill. However, this system is temporary. If Congress does not pass new legislation, the tax code will automatically revert to the pre-TCJA bracket structure on January 1, 2026. What does this reversion actually mean for your finances? In simple terms, it means tax rates are scheduled to increase for most levels of income. The pre-2018 system also featured 7 tax brackets, but the rates were notably higher. These rates were 10%, 15%, 25%, 28%, 33%, 35%, and a top marginal rate of 39.6%. To understand the real-world impact, let's compare these rate structures. The current 12% bracket is set to revert to a 15% rate. The 22% bracket will become 25%. The 24% bracket will jump to 28%. The 32% bracket will increase to 33%, and the current top rate of 37% will revert to the previous top rate of 39.6%. It is not just the rates that are changing. The income thresholds for each of these brackets will also revert to their pre-TCJA inflation-adjusted levels. This means the amount of income you can earn before moving into the next higher bracket will also change. Let's use a simplified, hypothetical example to illustrate this point. Please note, these figures are for illustrative purposes only and do not represent official future tax data. Imagine a single individual with a taxable income of $95,000. Under the current TCJA structure, their income would be taxed in segments. The first portion at 10%, the next portion at 12%, and the largest portion of their income at 22%. Now let's apply the pre-TCJA structure that is scheduled to return in 2026. With the same $95,000 of taxable income, this individual would still have their first portion of income taxed at 10%. However, the next segment would be taxed at 15%, and the subsequent larger portion would be taxed at 25%. The increase in the marginal rates from 12% to 15% and from 22% to 25% on significant portions of their income would directly lead to a higher overall tax liability, assuming all other factors remain constant. It is crucial to understand that the United States employs a progressive tax system. This means you do not pay your highest bracket's rate on your entire income. It is a common misconception. Instead, different portions of your income are taxed at progressively higher rates. When we discuss a rate increase, it's the marginal rate, the rate on your next dollar of income, that is going up. The effective tax rate, which is the actual percentage of your total income paid in taxes, will also rise for most people, but it will be an average of these different bracket rates. These changes will apply across all filing statuses, including single filers, those who are married filing jointly, married filing separately, and individuals filing as head of household. For those who are married and file a joint return, the income thresholds for each bracket are typically double those for single filers, but the same increases in the percentage rates will apply. The potential consequence of this bracket shift is straightforward. For a majority of American households, it could mean a smaller paycheck. When tax rates increase, the amount of money withheld for federal income taxes also increases, leading to a reduction in take-home pay. This could have a significant ripple effect, impacting everything from household budgets and discretionary spending to the ability to save for long-term goals like retirement or education. Furthermore, it's important to view this change not in isolation, but as part of a larger series of expirations. As we mentioned in our first chapter, the near doubling of the standard deduction is also set to expire. The combination of higher marginal tax rates and a lower standard deduction, which we will cover in our next chapter, could create a compounding effect, potentially leading to a more substantial tax increase than either change would cause on its own. We are currently in a period of anticipation. Lawmakers in Washington are fully aware of these looming deadlines. There will undoubtedly be extensive debates and discussions regarding the future of these tax provisions. The possibilities range from a full extension of the current law to a full reversion to the old law, or perhaps most likely, some form of new compromise legislation. The final outcome will depend heavily on the political and economic landscape as we approach the end of 2025. For now, the most empowering action you can take is to be informed. Understanding the mechanics of these scheduled changes is the essential first step in preparing for a different tax environment. Thank you for joining me for this detailed look at the upcoming income tax bracket changes. In our next chapter, we will turn our full attention to the standard deduction. We will explore the significant scheduled decrease and discuss how it will impact the decision-making process for millions of taxpayers when it comes to itemizing versus taking the standard deduction. I hope you will join me for that important discussion. Hello and welcome back to our series on the key U.S. tax law updates for 2026. In our previous chapters, we introduced the sunsetting provisions of the Tax Cuts and Jobs Act and took a deep dive into the scheduled changes for income tax brackets. Today, we will focus on another monumental shift, the change to the standard deduction. As always, this presentation is for educational purposes and should not be considered financial, legal, or tax advice. Please consult a qualified professional for advice pertinent to your unique situation. The standard deduction is a specific dollar amount that reduces the amount of your income on which you are taxed. In essence, it's a tax benefit that ensures all taxpayers have at least some income that is not subject to federal income tax. One of the most significant and widely felt changes from the Tax Cuts and Jobs Act of 2017 was a near doubling of the standard deduction. This change simplified tax filing for millions of American households, as it made it more advantageous to take the standard deduction rather than going through the more complex process of itemizing. However, like the tax brackets we discussed, this higher standard deduction is temporary. On January 1, 2026, it is scheduled to revert to pre-TCJA levels, adjusted for inflation. This change is so substantial that it has been described as the incredible shrinking standard deduction. Let's put some numbers to this to understand the scale of the change. For the 2025 tax year, the standard deduction for a single individual is projected to be around $15,000. For a married couple filing jointly, it's projected to be about $30,000. Now let's look at what happens in 2026 when the law reverts. Based on inflation projections, the standard deduction for a single filer is expected to drop to approximately $8,400. For a married couple filing jointly, it's projected to fall to around $16,700. As you can see, these amounts are roughly half of the current deductions. This is a dramatic reduction that will fundamentally change the tax equation for many people. So, what are the practical implications of this significant decrease? The most immediate consequence is that far more taxpayers will likely need to itemize their deductions to achieve a better tax outcome. Let's quickly review the difference. Taking the standard deduction is simple. You subtract a fixed amount from your adjusted gross income. Itemizing, on the other hand, involves tallying up specific deductible expenses throughout the year. These can include expenses like mortgage interest, state and local taxes, which we will cover in a future chapter, charitable contributions, and significant medical expenses. You choose whichever method, the standard deduction or your total itemized deductions, results in the larger deduction and thus, the lower taxable income. With the much higher standard deduction under the TCJA, The total of most people's itemized deductions did not exceed the standard amount. Therefore, it made sense for them to take the simpler path. For example, if a married couple's itemized deductions in 2025 totaled $25,000, they would still choose the standard deduction of approximately $30,000 because it's higher. But in 2026, that same couple with $25,000 in itemized deductions would find that their total is now significantly higher than the projected standard deduction of around $16,700. In this new scenario, they would be better off itemizing. This means that many Americans who have not had to track these specific expenses for years will need to resume meticulous record-keeping. It brings back a layer of complexity to tax filing that the TCJA had temporarily removed for a large portion of the population. Another critical element returning in 2026, alongside the lower standard deduction, is the personal exemption. The TCJA eliminated personal exemptions, which were per-person deductions you could take for yourself, your spouse, and your dependents. In 2026, personal exemptions are set to return. The projected value for each exemption will be around $5,300. This adds another variable to the calculation. Your total deduction in 2026 will either be the standard deduction plus any personal exemptions you can claim, or your total itemized deductions plus your personal exemptions. For many families, especially larger ones, the return of the personal exemption will be a significant benefit that helps to offset the impact of the lower standard deduction and higher tax rates. However, the net effect will vary greatly from one household to another, depending on income, family size, and the ability to itemize. In summary, the landscape of tax deductions is poised for a dramatic reshaping. The standard deduction, which became a broad and simple benefit for the majority, will shrink considerably. This will push many taxpayers back into the world of itemizing and detailed record-keeping. The return of the personal exemption will provide some relief, but the overall tax picture will become more complex. It's important to understand these mechanics not to create anxiety, but to foster awareness. Knowing that these changes are on the horizon allows for better preparation and understanding of your future financial picture. Thank you for joining me for this chapter. In our next installment, we will focus on a specific and often contentious itemized deduction that is also set to change: the state and local tax or SALT deduction. I look forward to exploring that topic with you then. Hello and welcome back. In our last chapter, we examined the scheduled reduction of the standard deduction and the return of personal exemptions. Today, we turn our attention to one of the most debated topics in federal tax law: the deduction for state and local taxes, commonly known as the SALT deduction. As we proceed, please remember this information is for educational purposes only and does not constitute financial, legal, or tax advice. Always consult with a qualified professional for guidance specific to your individual circumstances. For several years under the Tax Cuts and Jobs Act, the SALT deduction, which includes property taxes plus either state income or sales taxes, was capped at $10,000 per household. This was a significant change from the unlimited deduction that existed previously, and had a major impact on taxpayers in states with higher property and income taxes. This cap was scheduled to expire at the end of 2025. However, due to new legislation passed in mid-2025, known as the One Big Beautiful Bill Act, the situation has evolved significantly. Instead of the cap being eliminated entirely, the new law has transformed the SALT deduction landscape for 2026 and the next few years. For the 2026 tax year, the cap on the SALT deduction has been temporarily increased to $40,400. This is a substantial increase from the previous $10,000 limit, and provides significant potential tax relief for many homeowners and residents of high-tax states. For those who are married and file separately, this cap is set at $20,200. This higher cap means that many more taxpayers will find it beneficial to itemize their deductions once again. As we discussed in our last chapter, the standard deduction is set to decrease in 2026. The combination of a lower standard deduction and a much higher potential SALT deduction will make itemizing a more attractive option for a larger portion of the population. However, this expanded deduction is not available to everyone. The new law introduces an income-based limitation. For the 2026 tax year, the ability to claim the full $40,400 deduction begins to phase out for taxpayers with a modified adjusted gross income, or MAGI, above $505,000. Let's walk through how this phase-out works, as it's a crucial component of the new law. The deduction is reduced by 30% of the income you have above that $505,000 threshold. Let's use a simplified example to make this clear. Imagine a married couple filing jointly with a MAGI of $555,000. Their income is $50,000 over the threshold. We would take that $50,000 and multiply it by 30%, which equals $15,000. This $15,000 is the amount by which their SALT deduction is reduced. So their maximum SALT deduction would be $40,400 minus the $15,000 reduction, resulting in an allowable deduction of $25,400. It is important to note that the law includes a floor. The SALT deduction cannot be reduced below $10,000 for those subject to the phase-out. So even the highest income earners who can itemize will still be able to deduct up to $10,000 in state and local taxes. This new structure creates a tiered system. Taxpayers with MAGI under $505,000 can deduct up to the full $40,400. Those with income above this threshold will see their potential deduction gradually decrease. And taxpayers with very high incomes will effectively remain at the previous $10,000 cap. It is also critical to understand that this higher cap is temporary. Under the current law, the $40,400 cap is set to revert to a $10,000 cap in the year 2030. This creates a multi-year window where tax planning around state and local tax payments could be particularly relevant for some individuals. So in summary, the much-discussed expiration of the SALT cap has not resulted in a return to an unlimited deduction. Instead, new legislation has created a temporary, higher cap of $40,400 for 2026, complete with an income-based phase-out. This will undoubtedly encourage more households to itemize their deductions and will provide targeted relief, especially to residents in states with a higher cost of living and higher local taxes. Thank you for joining me for this important update. In our next chapter, we will shift our focus from individuals to businesses and explore the expiration of a major tax benefit for small business owners, the Qualified Business Income or QBI deduction. I look forward to you joining me then. Hello, and welcome back to our ongoing series exploring the U.S. tax landscape of 2026. In our previous discussions, we have covered significant changes to tax brackets, deductions, and credits affecting individual taxpayers. Today, we shift our focus to the business community and address a topic of immense importance to millions of entrepreneurs and small business owners: the Qualified Business Income or QBI deduction. As we begin, please remember this content is for educational purposes only and is not intended as financial, legal, or tax advice. We strongly recommend you consult with a qualified professional for guidance that is tailored to your specific business and financial situation. For years, the future of the QBI deduction, also known as the Section 199A deduction, has been a major question mark for business owners. It was created by the Tax Cuts and Jobs Act to provide a substantial tax break for pass-through businesses, which include sole proprietorships, partnerships, and S-corporations. This deduction allowed eligible owners to deduct up to 20% of their qualified business income, effectively lowering their tax rate. However, it was scheduled to expire completely at the end of 2025. This anticipated expiration has been a source of great uncertainty, but now the story has changed dramatically. Due to the passage of major tax legislation in mid-2025, the One Big Beautiful Bill Act, the 20% qualified business income deduction has been made a permanent feature of the U.S. tax code. This is a landmark development. Instead of facing a significant tax increase in 2026, owners of pass-through businesses now have the certainty that this valuable deduction will continue to be available. This permanence allows for much more effective long-term tax planning and business strategy. So, what does the QBI deduction look like in 2026 and beyond? The core principle remains the same. It allows an owner to deduct up to 20% of their qualified business income. However, the new law also solidified the rules and limitations that determine the final amount of the deduction. Let's briefly revisit how it works. The deduction is generally the lesser of two amounts: either 20% of your qualified business income, or 20% of your overall taxable income, not including capital gains. The complexity arises with certain limitations that apply once an owner's taxable income exceeds specific thresholds. For 2026, the new law has expanded these income thresholds, making the full deduction available to more business owners. If your taxable income is above the threshold, two main limitations can come into play. First is a limitation for what are called specified service trades or businesses, or SSDBs. These are fields like health, law, accounting, consulting, and financial services. For owners of these types of businesses with income above the threshold, the QBI deduction is phased out and eventually eliminated. Second, for businesses that are not SSDBs, The deduction can be limited based on the amount of W-2 wages the business pays to its employees and the value of its physical assets. Specifically, the deduction cannot exceed the greater of either 50% of W-2 wages paid or 25% of W-2 wages paid plus 2.5% of the unadjusted basis of qualified property. These wage and property limitations are designed to ensure the tax benefit is tied to businesses that are creating jobs and investing in the economy. The new law has also adjusted the income ranges over which these limitations are phased in, providing a more gradual reduction of the deduction for those affected. The most significant change is the certainty that this framework is now here to stay. Before this new legislation, business owners were planning for a world without the QBI deduction. They were facing the prospect of their business income being taxed at their full individual income tax rate, which, as we discussed in Chapter 2, is also scheduled to be higher. The combination would have resulted in a substantial tax hike. By making the QBI deduction permanent, the law ensures that the tax rate on pass-through business income remains competitive and avoids the so-called tax cliff that was looming in 2026. It solidifies a major tax benefit and provides a stable foundation for business planning for years to come. Thank you for joining me for this pivotal update. In our next chapter, we will return to individual tax planning and discuss a major change affecting families: the reversion of the child tax credit to its pre-TCJA rules. I look forward to you joining me then. Hello, and welcome back to our in-depth look at the U.S. tax code in 2026. In our last chapter, we celebrated some welcome news for business owners regarding the now permanent QBI deduction. Today, we turn our attention to a topic of immense importance for American families: the child tax credit. As we continue, please remember that this information is for educational purposes only. It is not intended to be financial, legal, or tax advice. We strongly encourage you to consult with a qualified professional for guidance regarding your specific personal circumstances. For several years, there has been widespread discussion and concern about the future of the child tax credit. Under the Tax Cuts and Jobs Act, the credit was doubled to $2,000 per child, providing significant financial support to families. However, like many other provisions, this expanded credit was scheduled to expire at the end of 2025. The law was set to revert to its pre-2017 form, which would have cut the credit in half to just $1,000 per child and lowered the income eligibility thresholds dramatically. But in a pivotal legislative development, this expected reversion is no longer happening. The major tax legislation passed in mid-2025, the One Big Beautiful Bill Act, has prevented the expiration and established a new, permanent framework for the child tax credit. Let's break down what the child tax credit will actually look like for families in 2026. First, the maximum credit amount has been increased. Instead of reverting to $1,000, the new law first increased the credit to $2,200 per qualifying child starting in 2025. Even more importantly, starting in 2026, this $2,200 amount will be adjusted annually for inflation. This is a critical new feature. It means the value of the credit will no longer erode over time due to rising costs, ensuring it provides more consistent support for families year after year. Second, let's discuss refundability. The refundable portion of the credit, known as the additional child tax credit, allows families to receive money back even if they don't owe any federal income tax. The new law maintains the existing structure for this. The maximum refundable amount per child is capped at $1,700 for 2026. To qualify for the refundable portion, you must have earned income of at least $2,500. The credit then phases in at a rate of 15 cents for every dollar earned above that $2,500 threshold, up to the maximum refundable amount. So while the credit itself is larger, the rules for getting it as a refund if you have low or no tax liability have not changed. Third, the income phase-out thresholds that determine who is eligible for the credit have been made permanent. The credit will continue to phase out for taxpayers with an adjusted gross income above $400,000 for married couples filing jointly, and above $200,000 for all other filers, such as single parents and heads of household. These high thresholds ensure that the vast majority of middle-income American families remain eligible for the full credit. This new law represents a significant departure from the tax cliff families were expecting in 2026. A reversion to the old law would have meant a smaller credit, lower income limits, and a more complicated refundability calculation. Instead, families now have the stability of a larger, inflation-adjusted credit. To be eligible, the long-standing rules for a qualifying child still apply. The child must be under the age of 17 at the end of the tax year, be your dependent,
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
Be a U.S. citizen or resident, and have a social security number. In summary, the narrative around the child tax credit has shifted from one of an impending cut to one of newfound permanence and stability. The larger, inflation-adjusted credit will continue to be a cornerstone of financial support for families across the country. Thank you for joining me for this crucial update. In our next chapter, we will address another area that was set to revert to prior law, with significant consequences for high-income earners and those with complex finances. The Alternative Minimum Tax, or AMT. I look forward to navigating that topic with you then. Hello, and welcome back to our series, Key U.S. Tax Law Updates for 2026. In our last chapter, we discussed the new, permanent landscape for the child tax credit. Today we're tackling a topic that has historically been one of the most feared and confusing aspects of the tax code for middle and upper income earners: the Alternative Minimum Tax, or AMT. As always, this presentation is for informational and educational purposes only. It does not constitute financial, legal, or tax advice. We strongly recommend consulting with a qualified professional to understand how these rules may apply to your specific financial situation. First, what is the AMT? In simple terms, it's a parallel tax system. It was originally created decades ago to ensure that high-income individuals who used numerous deductions and tax breaks couldn't reduce their tax liability to zero. Essentially, you calculate your tax liability under both the regular tax system and the AMT system, and you pay the higher of the two amounts. Under the Tax Cuts and Jobs Act, the reach of the AMT was drastically reduced. The law significantly increased the AMT exemption, an amount of income that is shielded from the AMT, and also raised the income level at which that exemption begins to phase out. This meant very few households were affected by the AMT between 2018 and 2025. However, this fix was temporary and set to expire, which would have caused a massive resurgence of the AMT in 2026, affecting millions of families. This is another area where the new legislation passed in 2025, the One Big Beautiful Bill Act, has intervened, creating a mixed but now permanent reality. The good news is that the new law makes the higher AMT exemption amounts permanent and continues to adjust them for inflation. This prevents the widespread return of the AMT that was feared. For 2026, the exemption amounts are projected to be approximately $91,000 for single filers and $142,000 for married couples filing jointly. This ensures a substantial amount of income is protected from the AMT calculation for most people. However, the new law introduces a significant change that will affect some higher-income taxpayers. It alters the rules for the exemption phase-out. For 2026, the income threshold where the exemption begins to be reduced is set at $500,000 for single filers and $1 million for married couples filing jointly. While these thresholds are high, they are slightly lower than they would have been under a simple extension of the TCJA. More importantly, the new law doubles the rate at which the exemption is phased out. Starting in 2026, the exemption will be reduced by 50 cents for every dollar of income above the threshold, instead of the previous 25 cents. This means the exemption disappears much more quickly for taxpayers with incomes above these levels, increasing the likelihood that they will be subject to the AMT. So who still needs to be mindful of the AMT in 2026? While most taxpayers will not be affected, the risk increases for those who have a combination of high income and specific types of deductions or income items. Common triggers for the AMT include exercising a large number of incentive stock options, or ISOs. Another major factor is having very high state and local tax deductions. Even with the new, higher $40,400 SALT cap we discussed in Chapter 4, state and local taxes are not deductible at all under the AMT calculation, which can push someone into AMT liability. Other triggers can include receiving tax-exempt interest from certain private activity bonds, or having large long-term capital gains. In summary, the story of the AMT in 2026 is one of a bullet dodged for the majority, but with a new layer of complexity for those in higher income brackets. The threat of millions of middle-class families suddenly being hit by the AMT has been averted. The system remains primarily targeted at higher earners, but the more aggressive phase-out of the exemption means that it will now catch more of those individuals than it has in recent years. Thank you for joining me for this complex but important topic. In our next chapter, we will discuss a subject of great importance for long-term wealth planning: the future of the federal estate and gift tax exemption. I look forward to you joining me then. Hello, and welcome back to our comprehensive guide on the evolving U.S. tax laws. In our last chapter, we navigated the complexities of the reshaped alternative minimum tax. Today, we turn to a topic of profound importance for long-term family financial planning and wealth transfer: the federal estate and gift tax exemption. As we delve into this subject, please remember that this content is for educational purposes only. Estate planning is a highly personalized and complex field, and this information should not be taken as financial, legal, or tax advice. It is essential to consult with qualified professionals to create a strategy that fits your unique circumstances. For years, the estate planning community has been preparing for a significant event known as the sunset of the historically high estate tax exemption created by the Tax Cuts and Jobs Act. The exemption, which was nearly $14 million per person in 2025, was scheduled to be cut in half on January 1, 2026. This looming deadline created a sense of urgency for many families to make large gifts to utilize the high exemption before it was gone. However, in a landmark legislative shift, this anticipated reduction is no longer going to happen. The One Big Beautiful Bill Act, passed in mid-2025, has completely rewritten the future of the estate tax. Instead of reverting to a lower amount, the law has established a new, permanent, and even higher federal estate and gift tax exemption. Effective January 1, 2026, the federal estate tax exemption is set at $15 million per individual. For a married couple, this means a combined exemption of $30 million. This is the total amount of assets that an individual can give away during their lifetime, or leave to their heirs at death without being subject to the federal estate tax. Any amount transferred above this exemption is typically taxed at a rate of 40%. Crucially, the new law also dictates that this $15 million figure will be indexed for inflation in future years, beginning in 2027. This provides a stable and predictable foundation for long-term estate planning, removing the uncertainty that has surrounded this area of tax law for over a decade. Another key feature that remains in place is portability. Portability allows a surviving spouse to use any unused portion of their deceased spouse's exemption. For example, if one spouse passes away having used only $5 million of their $15 million exemption, the surviving spouse can add the remaining $10 million to their own exemption, provided the proper election is made on the deceased spouse's estate tax return. This continues to be a powerful tool for married couples. It is also important to distinguish the lifetime exemption from the annual gift tax exclusion. The annual exclusion, which was $19,000 in 2025, is the amount you can give to any number of individuals each year without it counting against your $15 million lifetime exemption. This remains a valuable tool for gradually reducing the size of a taxable estate over time. The establishment of this new, permanent $15 million exemption is one of the most significant developments in this series. It averts the massive tax increase that would have occurred under the old law's sunset provision, and provides a clear, stable framework for the future. Fewer estates in the United States will now be subject to the federal estate tax. For those with estates valued near or above these new thresholds, however, strategic planning remains as important as ever. Thank you for joining me to discuss this pivotal change. In our next chapter, we will examine some of the miscellaneous, but still impactful, tax deductions and credits that are also changing in 2026. I look forward to exploring those with you then. Hello and welcome back to our series, Key U.S. Tax Law Updates for 2026. In our previous chapters, we've covered the major headlines: permanent changes to tax rates, business income, family credits, and the estate tax. Today, we're going to examine the fine print, the smaller but still significant changes to specific deductions and limitations that will add a new layer of complexity to tax filing in 2026. As we proceed, please remember this information is for educational purposes only and does not constitute financial, legal, or tax advice. We strongly recommend consulting with a qualified professional for guidance specific to your personal tax situation. One of the key simplifying features of the Tax Cuts and Jobs Act was the elimination of a whole category of write-offs, known as miscellaneous itemized deductions. This category included things like unreimbursed employee business expenses, such as a home office for a W-2 employee, work-related travel, or union dues, as well as tax preparation fees and investment advisory fees. The suspension of these deductions was set to expire in 2026, and many taxpayers expected them to return. However, in a significant policy decision, the One Big Beautiful Bill Act, passed in 2025, has made the elimination of most miscellaneous itemized deductions permanent. This means that for the vast majority of taxpayers, the ability to deduct unreimbursed employee expenses and other similar costs will not be coming back. This solidifies a major shift in the tax code, placing the cost of these work-related expenses squarely on the employee, not as a shared cost with the government through a tax deduction. The second major change we need to discuss is the introduction of a new limitation on itemized deductions for higher-income taxpayers. Before the TCJA, a rule known as the PEAS limitation would reduce the total value of a person's itemized deductions once their income crossed a certain threshold. The TCJA eliminated this rule. Now, starting in 2026, a new, more powerful version of this limitation is being introduced. The new rule will primarily affect taxpayers in the highest 37% tax bracket. It works by reducing the value of their total itemized deductions. This includes mortgage interest, charitable contributions, and state and local taxes, by a specific formula. The technical calculation reduces the deduction by about 5.4%, which effectively caps the tax benefit of each dollar they deduct at the 35% tax rate level, instead of their top 37% rate. While this may seem like a small change, it acts as a subtle tax increase for high-income households that itemize, reducing the financial incentive of their deductions. Finally, let's look at two other specific deductions that have been permanently changed. First is the deduction for personal casualty and theft losses. The TCJA rule, which limited this deduction only to losses occurring in a federally declared disaster area, has been made permanent. However, the new law does expand this slightly. Starting in 2026, you can also deduct losses from disasters that are officially declared by a state's governor, even if they don't receive a federal declaration. The old rule allowing deductions for more common events like a house fire or theft outside of a disaster area is not returning. Second is the deduction for moving expenses. The TCJA suspended the ability for most people to deduct the costs of moving for a new job. The new legislation has made this suspension permanent as well. The only individuals who can still deduct moving expenses are active duty members of the armed forces who are moving due to a military order. For the general workforce, relocation expenses are no longer tax deductible. In summary, while some parts of the old tax code were expected to return in 2026, the new law has instead carved a different path. It has permanently eliminated many popular deductions, like those for employee expenses and moving, while introducing a new, complex limitation on the value of deductions for high earners. This reinforces a key theme. The tax code in 2026 is not a simple return to the past, but a unique new system. Thank you for joining me. In our next chapter, we will focus on education, exploring the tax credits and deductions designed to help pay for higher education. I look forward to you joining me then. Hello, and welcome back to our in-depth exploration of the U.S. tax code. In our last chapter, we sorted through the fine print of miscellaneous deductions and new limitations. Today, we turn to a subject that impacts millions of students and families across the nation: the tax benefits designed to make higher education more affordable. As we navigate this topic, please remember that this information is for educational purposes only and is not intended as financial or tax advice. The rules for education benefits can be complex, and we strongly encourage you to consult with a qualified professional to determine your eligibility. For 2026, the tax landscape for education has been stabilized by the new legislation passed in 2025. Instead of expiring, the key tax credits and deductions have been made a permanent part of the tax code, providing certainty for families planning for college and other educational pursuits. Let's break down the three primary benefits available. First is the American Opportunity Tax Credit, or AOTC. This is the most valuable credit for most undergraduate students. The AOTC allows you to claim a maximum annual credit of $2,500 per eligible student for the first 4 years of higher education. It is calculated as 100% of the first $2,000 of qualified education expenses and 25% of the next $2,000. What makes the AOTC especially powerful is that it is partially refundable. Up to 40% of the credit, or $1,000, can be received as a refund even if you don't owe any tax. To claim the full credit in 2026, your modified adjusted gross income must be $80,000 or less for single filers, or $160,000 or less for those married filing jointly, with the credit phasing out for incomes above those levels. The second major benefit is the Lifetime Learning Credit, or LLC. This credit is broader than the AOTC. It isn't limited to the first 4 years of college and can be used for undergraduate, graduate, and professional degree courses. It's also available for courses taken to acquire or improve job skills. For 2026, the LLC is worth 20% of the first $10,000 in educational expenses, up to a maximum of $2,000 per tax return, not per student. A key difference is that the LLC is non-refundable, meaning it can reduce your tax liability to zero, but you won't get any of it back as a refund. The income limits for the LLC are also a bit lower than for the AOTC. The third key benefit is the student loan interest deduction. This allows you to deduct the interest you paid on a qualified student loan during the year. For 2026, you can deduct up to $2,500 in student loan interest. This is known as an above-the-line deduction, which is a great feature because it means you do not have to itemize your deductions to claim it. Like the credits, this deduction is also subject to income limitations. A final, significant update for 2026 involves 529 education savings plans. The new law has doubled the amount that can be withdrawn tax-free for K through 12th grade expenses, increasing the annual limit from $10,000 to $20,000 per student. The law also permanently expanded the definition of qualified K-12 expenses beyond just tuition to include costs like books, tutoring, and dual enrollment programs. In summary, the 2026 tax year offers a stable and robust set of benefits to help offset the cost of education. The powerful, partially refundable AOTC remains the go-to credit for undergraduates. The flexible LLC supports graduate students and lifelong learners, and the student loan interest deduction provides relief after graduation. Thank you for joining me. In our next chapter, we will shift our focus to long-term financial planning as we explore the rules and updates for retirement savings accounts like 401(k)s and IRAs. I look forward to you joining me then. Hello, and welcome back to our series on the U.S. tax law updates for 2026. After covering education benefits in our last chapter, we now turn our focus to long-term financial security, retirement savings. This is an area of stability in some respects, but with one major new rule taking effect that many savers need to understand. As always, this information is for educational purposes only. Retirement planning involves many personal factors, and this content should not be considered financial or tax advice. We strongly encourage you to consult with a qualified financial advisor. First, let's cover the good news. The One Big Beautiful Bill Act, passed in 2025, did not fundamentally change the structure of popular retirement plans like 401(k)s and IRAs. This means the system remains consistent, and the annual contribution limits will continue to receive their normal cost of living adjustments. For 2026, the maximum employee contribution to a 401(k) or similar workplace plan is projected to increase to approximately $24,500. Catch-up contributions for those age 50 and over are also seeing an inflation adjustment. The standard catch-up amount is expected to rise to $8,000. And for those aged 60, 61, 62, and 63, the special higher catch-up limit established by prior legislation remains in effect at $11,250. Similarly, the annual contribution limit for both traditional and Roth IRAs is also expected to see an inflation increase for 2026. Now we must turn to the most significant retirement savings change for 2026. This is a new rule that was part of prior legislation but was delayed and is now mandatory. It concerns catch-up contributions for high-income earners. Starting January 1, 2026, if you earn more than $145,000 in the prior calendar year, that is, in 2025, any catch-up contributions you make to your workplace retirement plan must be made on a Roth, or after-tax, basis. The $145,000 threshold will be adjusted for inflation in future years. Let's break down what this means. A traditional, pre-tax contribution lowers your taxable income today. A Roth contribution does not give you an upfront tax break, but your qualified withdrawals in retirement are completely tax-free. This new rule eliminates the option for high earners to get an immediate tax deduction on their catch-up contributions. Instead, those extra savings will be directed into a Roth account, providing for tax-free growth and withdrawals down the road. This has a critical implication for employers as well. If a company's 401(k) plan does not have a Roth contribution feature, then their high-income employees will not be able to make any catch-up contributions at all. This has prompted many employers to add a Roth option to their plans to ensure all employees have access to the same savings opportunities. Finally, for retirees, the rules for required minimum distributions, or RMDs, remain stable. The RMD age for 2026 is 73. This is the age at which you generally must start taking withdrawals from your traditional retirement accounts. The previously passed law that will eventually raise the age to 75 does not take effect for many years. In summary, while the foundation of retirement savings remains steady with increasing contribution limits, the mandatory Roth treatment for catch-up contributions by high earners is a major strategic shift. It changes the tax calculation for those savings from an immediate benefit to a future one, requiring a new level of awareness from both employees and employers. Thank you for joining me. In our next chapter, we will dive into a growing and complex area of the economy: the tax rules and considerations for self-employed individuals and gig economy workers. I look forward to you joining me then. Hello and welcome back. In our last chapter, we focused on long-term retirement planning. Today, we're addressing one of the fastest-growing segments of the American economy: the self-employed, including freelancers, independent contractors, and gig economy workers. If you earn income outside of a traditional W-2 job, this chapter is for you. As we cover these important topics, please remember this information is for educational purposes only and is not tax or legal advice. The world of self-employment tax is complex, and we strongly recommend consulting with a tax professional. When you work for yourself, you are, in the eyes of the IRS, a small business owner. This brings a new set of tax responsibilities that are very different from being a traditional employee. Let's start with the most significant one: self-employment tax. When you work for an employer, they withhold Social Security and Medicare taxes from your paycheck, and they pay a matching employer portion. When you're self-employed, you are responsible for paying both the employee and employer portions. This combined tax is known as the self-employment tax, and for 2026, the rate is 15.3% on your net earnings. This tax is in addition to your regular federal income tax. However, you do get to deduct 1/2 of what you pay in self-employment tax, which helps to lower your overall tax bill. The next key to managing your tax life as a freelancer is understanding business deductions. To lower both your income tax and your self-employment tax, you need to track all of your ordinary and necessary business expenses. Keeping meticulous records of these expenses is not optional. It is essential. Common deductions for gig workers include vehicle mileage. If you use your car for work, you can deduct the costs. You can use either the standard mileage rate set by the IRS or track the actual costs of gas, oil, repairs, and insurance. Supplies. This includes anything from raw materials for a product you sell to cleaning supplies for a rental property. Home office deduction. If you use a part of your home exclusively and regularly for your business, you may be able to deduct a portion of your rent, mortgage interest, and utilities. Business use of your phone and internet. The third critical element, which we discussed in Chapter 5, is the Qualified Business Income, or QBI deduction. The new law has made this powerful deduction permanent. For most self-employed individuals, this allows you to deduct an additional 20% of your net business profit, after all your other expenses. This is one of the most significant tax benefits available to independent contractors, and can substantially reduce your taxable income. Finally, because taxes are not being automatically withheld from your pay, you are responsible for paying them to the IRS throughout the year. This is done through estimated tax payments. Generally, you must calculate your expected income and self-employment tax for the year, and pay it in 4 quarterly installments. This pay-as-you-go system helps you avoid a large, unexpected tax bill and potential underpayment penalties when you file your annual return. In summary, thriving as a self-employed individual requires a shift in mindset. You must diligently track all your business income and expenses, set aside money for both income and self-employment taxes, and make your quarterly estimated payments. By embracing these responsibilities, you can take full control of your financial future. Hello and welcome back. In our last chapter, we navigated the essential tax rules for the growing self-employed workforce. Today, we turn our attention to a cornerstone of the American dream and a major financial milestone for millions: homeownership. Owning a home comes with a unique set of tax benefits and rules that are important to understand. As always, this information is for educational and informational purposes only and should not be considered financial or tax advice. Please consult with a qualified professional to understand how these rules apply to your personal financial situation. For 2026, the tax rules for homeowners have been clarified and made permanent by the new legislation, providing a stable foundation for financial planning. Let's explore the 3 main tax considerations for homeowners. First is the mortgage interest deduction. If you itemize your deductions, you can generally deduct the interest you pay on your mortgage. The new law has made the existing limit permanent. This means you can deduct the interest on up to $750,000 of mortgage debt used to buy, build, or substantially improve your primary or second home. It's also important to note that interest on a home equity loan or line of credit is only deductible if the funds are used for these same purposes, improving the home, and the total debt does not exceed the $750,000 limit. The second major deduction for homeowners is for property taxes. The real estate taxes you pay to your local government are deductible on your federal return if you itemize. However, this deduction is part of the overall state and local tax, or SALT deduction. As we discussed in Chapter 4, the new law has significantly increased the SALT deduction cap. For 2026, you can deduct a combined total of up to $40,400 for your property taxes plus either your state income taxes or state sales taxes. This is a major improvement from the previous $10,000 cap, and will allow more homeowners to deduct a larger portion, if not all, of their property tax bill. The third and perhaps most valuable tax benefit is the home sale exclusion, also known as the Section 121 exclusion. This powerful rule allows you to exclude a large amount of profit from being taxed when you sell your main home. The exclusion amounts, which were not changed by the new law, remain at $250,000 for single filers and $500,000 for married couples filing jointly. To qualify for this exclusion, you must meet both the ownership and use tests. This means you must have owned the home and lived in it as your primary residence for at least 2 of the 5 years leading up to the date of sale. The 2 years do not have to be consecutive. This rule allows most homeowners to sell their primary residence and walk away with their profits completely tax-free, as long as the gain is below the exclusion limits. In summary, the 2026 tax code provides a clear and stable set of rules for homeowners. The mortgage interest and property tax deductions offer annual benefits for those who itemize, and the home sale exclusion provides a significant tax-free benefit when it comes time to sell. Thank you for joining me. In our next chapter, we will explore the other side of real estate, focusing on the tax rules and considerations for owning rental and investment properties. I look forward to you joining me then. Hello and welcome back. In our last chapter, we covered the essential tax rules for personal homeownership. Today, we're stepping into the world of real estate investing and exploring the fundamental tax principles for owning and operating a rental property. When you rent out a property, you are running a business, and it's critical to understand the rules. As always, this information is for educational purposes only and should not be seen as investment, legal, or tax advice. We strongly recommend consulting with a qualified professional to discuss your specific investment property situation. The first rule of being a landlord is that all income you receive must be reported. This isn't just the monthly rent check. Rental income also includes advance rent, late fees, application fees, and any portion of a security deposit that you do not return to a tenant. If a tenant pays for a repair or a utility bill on your behalf in exchange for a reduction in rent, that amount is also considered rental income to you. This income is typically reported on Schedule E of your tax return. The second rule is that you can and should deduct all of your ordinary and necessary expenses. Keeping meticulous records of every dollar you spend on the property is the key to minimizing your tax burden. Common deductible expenses for landlords in 2026 include mortgage interest. The interest you pay on the loan for the property is fully deductible. Property taxes. These are also fully deductible against your rental income. Insurance. The cost of landlord and hazard insurance policies. Repairs and maintenance. The cost of routine repairs like fixing a leaky faucet, patching a wall, or paying for pest control. Management fees. Fees paid to a property manager or company. Utilities. Any utilities that you, the owner, pay for, such as water or garbage collection. The third fundamental concept you must understand is that the IRS generally considers rental real estate to be a passive activity. This has a very important implication. In most cases, if your rental expenses are greater than your rental income, creating a loss, you can only use that passive loss to offset income from other passive activities. You generally cannot use a rental loss to offset your active income, such as the salary from your job. However, there is a major exception to this rule for small landlords. If you actively participate in managing your rental, which can be as simple as making management decisions like approving tenants and repairs, you may be able to deduct up to $25,000 of your rental losses against your non-passive income. This special allowance begins to phase out once your modified adjusted gross income exceeds $100,000. and is completely phased out once your income reaches $150,000. In summary, treating your rental property like a business is the key to success. This means diligently tracking all forms of income, meticulously recording every deductible expense, and understanding the passive activity rules that govern how you can use any potential losses. Thank you for joining me.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.